Welcome to Looking at the Markets with David Modell. Today I want to give you an introduction to RSI. So here we go. What is RSI? Well, RSI is Relative Strength Index. It's a technical indicator for stocks or ETFs or commodities, currencies, etc. It was featured by Weles Wilder in the 1978 book New Concepts in Technical Trading Systems. Here is his formula for the RSI in case you're curious. Thankfully, you don't need to know it in order to use it. So, in case you're curious about the math behind RSI, there's the formula. RSI is an oscillator, which is just a fancy way of saying that it's a line that goes up and then down, then up, then down, and so on. It's also a momentum indicator, which means that it indicates the general overall direction or trend of a stock or ETF or whatever. So when the RSI is going up, that means that the stock price is trending upward. When the RSI line is going down, that means that the stock price is generally trending downwards. It's very often used as a overbought or oversold indicator, meaning that it will tell you when a stock is overbought, like here and here. And overbought means expensive, okay? Means it's at a high price. Or when it's oversold, like here and here and here. And oversold is just a fancy way of saying that it's relatively cheap, or it's on sale, or a bargain, etc. Medium-term or swing traders will often use the RSI 14, or the 14-period RSI. And you can see we have it right here, RSI 14, which calculates the RSI using the most recent 14 days on the daily candlestick chart. And all these charts are coming from stockcharts.com, because I wanted to give them credit. All right, so this is an example of the 14-period RSI. A popular strategy is to wait until the RSI goes below 30, which is considered oversold or cheap. So if this is the 30 line here, that horizontal line here, okay, and you can see here the RSI line went below 30. Okay, it actually went to about 20 or so. So a popular strategy is to wait until the RSI goes below 30, which is considered oversold or cheap, then wait until it comes back up above 30. So here it is, and it came up, back up, out of oversold territory, back above 30. And then buy the stock. So you can buy it right here when it goes back up, when it goes below 30 and then goes back up above 30. A lot of people will buy here. People who own the stock might wait until the RSI goes above 70, and here's the 70 line, okay? And you can see here that the RSI line went, it's hard to see, but it went a little bit above 70 right here. Okay, so people who already own the stock might wait until the RSI goes above 70, which is considered overbought or expensive, and then wait until it goes back below 70, out of overbought territory. And then they might sell the stock. Okay, so it went above 70 a little bit and then went back down below 70, and they might sell it here if they already own the stock. If they are into shorting or short selling, then they might possibly even short or short sell the stock after it goes up above 70 and then back below 70. They might sell or short sell it here. Alright, so we're going to use SLV, which is an ETF or exchange traded fund representing the price of silver. Okay, and this is the daily candlestick chart. Each candlestick here represents 1 day of price action. And so we've put the RSI below the price, below the candlesticks. Okay? And so as you can see, if you had, alright, let's say you had waited until the RSI 14 period went below 30 into oversold territory, and then popped back above 30 out of oversold territory. And if you had bought here, you would have bought right about here, and if you had held on, you would have enjoyed a pretty good profit here, pretty good run up. All right. And if you're into selling or short selling using the RSI, then you might have, let's say you already owned SLV and you wanted to know when to sell it. You could have waited until it went above 70 and then popped back down below 70 out of overbought territory, right about there, which would be right about here. Okay, and so if you already owned SLV, you might have decided to sell it here because of the RSI indicator, and that would have been a good decision because pretty soon afterward it went down a lot. And you might have even shorted it here or short sold it, and that would have worked out pretty well if you had taken your profits around here. The highest the RSI can go is 100, and the lowest it can go is 0, though it rarely goes that far. And let's take another look at SLV. As you can see, if this is 10, then 0 would be way down here, and it doesn't often go to 0. And if this is 90, then 100 would be way up here, and it would have to be really overbought or expensive to go up to 100. And as we know, it oscillates between 0 and 100, and more often between 30 and 70, or oversold and overbought. You don't have to use the 14-period RSI, as you can change the look-back period to any number. For example, you could use the RSI 5-period to see the short-term trend, and you will get overbought and oversold signals more frequently. For a longer duration trend, you could use a bigger number, such as the RSI 30. And so you can adjust the period there, all right? I hope this was helpful. This was just an introduction. There's much more to learn about RSI and other indicators. So please give this video a thumbs up on YouTube, leave comments, and please subscribe to my YouTube channel so you can receive the latest updates on my financial educational videos. And if you'd like to contact me, if you have questions or you want some help putting together a trading plan or learning about technical indicators or anything we've talked about today, you can email me at any time. My name is David Modell, and my email address is davidmodell@gmail.com. Thank you so much for watching and listening, and I'll talk to you again soon.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.